I've been in banking for over 40 years. I've run the largest bank in America for nearly 2 decades. I've navigated the 2008 financial crisis and every market turbulence since. And today, I'm going to tell you something that might shock you. Your money is dying in your bank account. I know that sounds crazy coming from a banker, but I run JP Morgan Chase and I know exactly how this system works. I know what happens behind those vault doors. In 2026, keeping your money in traditional bank accounts isn't just a bad strategy, it's financial suicide. Today, I'm walking you through the 5 deadly mistakes that 90% of Americans are making right now, and I'm telling you exactly what to do about it. Before we dive in, let me give you context about where we are in 2026. When I started on Wall Street in 1982, interest rates were in double digits. If you put $10,000 in a savings account, you could actually make real money from interest alone. That world is gone. Since 2008, central banks have printed more money than in the previous century combined. They've manipulated interest rates to impossible levels. Here's what most people don't understand. The banking system today is fundamentally different. The rules have changed. And if you're still operating under old assumptions, you're going to get crushed. First, inflation isn't going away. Despite what the Fed says, the structural forces driving inflation, supply chain restructuring, deglobalization, massive government debt are the new reality. Second, real interest rates are deeply negative for savers. If your bank pays 4%, but inflation runs at 6, 5%, you're losing money every single day. Third, the banking system is more fragile than people realize. Silicon Valley Bank, First Republic, major players collapsed in days. Now, I'm not here to create panic. JP Morgan Chase is rock solid, but not every bank is JP Morgan Chase. And even if your bank is safe, it doesn't mean your money's working for you. Mistake 1, believing your savings account is safe money. The first deadly mistake is thinking money in your savings account is safe money. People say, Jamie, I keep 6 months of expenses in savings because that's responsible. I appreciate the sentiment, but there's a difference between emergency cash and letting large amounts rot in low interest accounts. Let me give you the math. The average savings account pays 0.4% annual interest. High yield accounts might pay 4 to 5%. Sounds good, right? Wrong. Because real inflation in 2026 is running at 6.5%, not the manipulated CPI. I'm talking about real cost increases in groceries, gas, insurance, dining. So if you have $50,000 earning 4% interest, you make $2,000 yearly before taxes. After 25% taxes, you net $1,500. But with 6.5% inflation, your $50,000 loses $3,250 in purchasing power annually. Net result, you're losing $1,750 every year, guaranteed. That's not safe money. That's slowly bleeding to death. But Jamie, what about FDIC insurance? My deposits are insured to $250,000. Let me explain something about FDIC insurance most people don't understand. Yes, FDIC protects you if your bank fails, but it doesn't protect you from asterisk, asterisk, inflation, asterisk, asterisk. It doesn't protect you from your money losing purchasing power. FDIC insurance is a safety net against bank failure. It's not a wealth building strategy. In 2008, during the crisis, I was in emergency meetings with Hank Paulson, Ben Bernanke almost daily. The financial system was collapsing. People with FDIC insured accounts got their money back. The system worked, but the Fed dropped interest rates to 0 for 7 years. If you kept money in savings, you earned nothing while your cost of living climbed year after year. They preserved their nominal dollars but lost massive purchasing power. When you keep large amounts in a bank account, you're making implicit bets. The dollar will maintain value, inflation will stay low, there won't be better opportunities. In 2026, all 3 bets are losing propositions. The dollar is being systematically devalued. We've added over $10 trillion to national debt recently. The money supply has exploded. When you keep money in a bank, you're lending at negative real rates, while the bank lends it out at positive rates. The bank makes the spread, you lose purchasing power. You should have emergency savings, 3 to 6 months of expenses. But parking $100,000 or $200,000 in savings isn't prudent planning. It's wealth destruction. Mistake 2, ignoring the negative real interest rate trap. This leads to the second deadly mistake, ignoring negative real interest rates. Most people don't understand what a real interest rate is. Nominal interest rate is what the bank pays. If your account pays 4%, that's nominal. Real interest rate is nominal rate minus inflation. If you get 4%, but inflation is 5%, your real rate is negative 2.5%. This is the number that matters for your wealth. Real interest rates for savers have been negative for most of the last 15 years. They're deeply negative now in 2026, and they'll likely stay negative for years. Why? The government and Federal Reserve are trapped. The U.S. has over $36 trillion in debt. Every 1% rate increase costs the government hundreds of billions in interest payments. Interest payments are becoming one of the largest budget line items. That money comes from somewhere. Raise taxes, cut spending, or inflate the debt away. Which will politicians choose? They'll choose inflation, always. It's politically easiest. So the Fed talks tough about fighting inflation. They raise rates a little, but they can't raise them enough to beat inflation because doing so would bankrupt the government and crash the economy. Meanwhile, government spending remains wildly expansionary. Infrastructure, defense, entitlements, spending never stops. Toxic combination, interest rates too low to beat inflation, combined with fiscal policy keeping inflation elevated. Savers get crushed. If you're sitting on $200,000 earning 4% while inflation runs 6 to 7%, you're losing $4,000, $6,000 yearly in real purchasing power, compounded. Over 10 years at 6% inflation, your $200,000 will have the purchasing power of about $111,000 today. You'll lose nearly half your wealth by being safe. This is the negative real interest rate trap. You feel responsible keeping money in the bank. The government and Fed benefit from this. Negative real rates are effectively a stealth tax on savers. Your purchasing power transfers to borrowers, primarily the government, through inflation. It's the most politically convenient wealth redistribution ever invented. Because most people don't realize it's happening. They see their balance staying the same or growing slightly. They don't realize that dollars are worth less every year. I've sat in meetings where policymakers discuss this openly. Some explicitly see negative real rates as a feature, not a bug. It's how you manage unsustainable debt without triggering explicit default. But it destroys savers. Mistake 3, keeping more than $250,000 in a single bank. The third deadly mistake is exceeding FDIC insurance limits at one institution. I see this constantly with professionals, business owners, retirees. They've accumulated $500,000, $800,000, over $1 million in cash, and they keep it all at one bank. This is dangerous. Let me tell you about Silicon Valley Bank in March 2023, second largest bank failure in U.S. history. SVB was real. Over $200 billion in assets, served thousands of tech companies, FDIC insured, regulated like JP Morgan Chase. It collapsed in 48 hours. If you had $250,000 or less, you were fully protected. But if you had $1 million, only $250,000 was insured. The other $750,000 was at risk. The government stepped in and made depositors whole, but they didn't have to. No guarantee they'll do that next time. Here's what people don't know. The FDIC has about $125 billion in its insurance fund. There are over $18 trillion in deposits in the U.S. banking system. The FDIC fund covers less than 1% of total deposits. If multiple large banks failed simultaneously, the fund would be wiped out instantly. Practical example. You're a business owner with $800,000 in checking for payroll and expenses. If your bank fails, only $250,000 is immediately protected. The other $550,000 goes into receivership. Eventually, weeks, maybe months, you'll probably get most back. Historically, uninsured depositors recover 70-90%, but eventually doesn't help if you need to make payroll Friday. Smart wealth managers never keep more than $250,000 at any institution. They spread cash across multiple banks using different account structures. It's called the FDIC insurance sweep strategy. Instead of $1 million at Bank A, keep $250,000 at banks A, B, C, and D. Now, all your money is fully insured. Yes, it's more complicated, but it beats losing half your life savings. If you have so much cash, you're worried about FDIC limits, you probably have too much cash in the first place. Mistake 4, falling for the liquidity trap. The fourth deadly mistake is the liquidity trap. People keep massive amounts in cash just in case they need it, even though they never actually need it. I see this with retirees. They've accumulated $1, $2 million, then they keep 30, 50% in cash for safety. When I ask why, they say, I might need it for emergencies, or I want quick access for opportunities, or I just sleep better knowing it's there. I understand that psychology. Cash feels safe. Cash is liquid, but you're paying enormous opportunity costs for psychological comfort. Say you have $2 million in retirement savings, you keep $800,000 in cash, earning 4%. A diversified portfolio might earn 8 to 10% annually long term. The difference between 4% and 9% on $800,000 is $40,000 per year. That's $40,000 in annual income you're giving up. For what? For optionality to access money you'll probably never need all at once. In what realistic scenario do you need immediate access to $800,000? Medical emergency? Insurance and Medicare cover most hospitals give payment plans. Home repair? Even major repairs rarely exceed $100,000, and you can finance them. Investment opportunity? Professional investors don't keep huge cash balances waiting. They keep money invested and redeploy when opportunities arise. The liquidity trap is almost always emotional, not rational. Yes, have emergency savings. 3 to 6 months of living expenses and liquid accounts is prudent. But if your annual expenses are $100,000, that's $50,000 in emergency savings, not $500,000, not $800,000. Everything above that is dead money. The liquidity trap becomes self-fulfilling. You keep cash worried about volatility, but because you're holding cash during high inflation, your purchasing power erodes. So you feel you need even more cash to maintain security. Meanwhile, invested assets appreciate in real terms. The gap between your wealth and people who stayed invested keeps widening. After 2008, people got scared. They sold stocks and put money in savings. Then they watched from sidelines as the stock market tripled over a decade. The S&P 500 went from 666 inches to March 2009 to over 3,000 by 2019. $100,000 invested at the bottom became $450,000. That $100,000 in savings earning 1% became $110,000. People who stayed liquid missed the entire recovery. It's happening again in 2026. People are scared and sitting on huge cash balances waiting for safety. But safety is an illusion when your dollars are melting. Mistake 5, ignoring alternative safe havens. The fifth deadly mistake, ignoring alternative safe havens. Most people think there are only two options, bank account or risky stocks. That's a false dichotomy. There are multiple alternatives providing better returns than bank accounts with comparable or lower risk. Alternative 1, treasury bills and money market funds. U.S. treasury bills are backed by the full faith and credit of the United States. As safe as FDIC, arguably safer. Right now in 2026, you can buy 3 to 6 month treasury bills yielding 4.5 to 5.5%, higher than most savings accounts and just as safe. Treasury interest is exempt from state and local taxes. In high tax states, your after-tax return on treasuries beats bank accounts at the same nominal rate. Money market funds invest in short-term treasuries and high-quality commercial paper. Liquid, safe, typically yield more than savings accounts. Alternative 2, short-term investment-grade bonds. If you lock money up for 1 to 3 years, instead of keeping it completely liquid, you can invest in short-term investment-grade corporate bonds. Bonds from Microsoft, Johnson & Johnson, Walmart, minimal credit risk, yields typically 1 to 2% higher than treasuries. Unlike bank accounts where you're stuck with whatever rate the bank pays, bonds have fixed coupons. Buy a 3-year bond paying 6%, you get 6% for 3 years regardless of what happens to rates. Alternative #3, I-bonds and tips. I-bonds are inflation-protected savings bonds from the U.S. Treasury. Interest adjusts every 6 months based on inflation. When inflation is high, like now, I-bonds can pay 5 to 7% plus, complete tax deferred until redemption. Only $10,000 per person per year, and you can't redeem for at least 1 year. TIPS Treasury, inflation-protected securities work similarly. Principal adjusts with inflation, so purchasing power is protected. Both are government guaranteed, inflation protected alternatives, objectively better than savings accounts in inflationary environments. Alternative four, high yield savings at online banks. Not all banks pay the same rates. Big national banks, including JP Morgan Chase, typically pay lower rates because they don't need deposits. Online banks and smaller credit unions often pay significantly higher rates. Right now, online savings accounts pay 5 to 5.5% compared to 0.5% at traditional banks. That's 10x difference in yield for the exact same FDIC insurance protection. Why accept 0.5% when you could get 5.5%? Usually inertia. That inertia costs thousands annually. Alternative five, structured notes and fixed index annuities. For sophisticated investors, there are structured products providing principal protection with equity-like returns. Structured notes might offer 80% principal protection with returns linked to the S&P 500. Market goes up 20%, you get 20%. Market drops 30%, you only lose 20%. Fixed index annuities work similarly. Insurance products guarantee in principle while giving market upside participation, typically with a cap, not for everyone, complex, have fees, lock up money for years. But for retirees wanting equity exposure without full downside risk, they're valuable. The point, you have options. You don't have to accept 0.5% interest. You don't have to keep $500,000 in checking. You don't have to watch purchasing power evaporate. What to do now? Let me give you a concrete action plan. If you're making these deadly mistakes, here's what to do. Step one, calculate your real emergency fund need, figure out monthly expenses, multiply by 3 to 6 months. That's your emergency fund. Everything else is excess cash that should work harder. Step two, make sure you're not exceeding FDIC limits. More than $250,000 at any single bank. Spread it across multiple institutions or use FDIC sweep programs. Step three, move emergency fund to highest yield option. Compare rates across online banks, money market funds, treasury bills. No reason except 0.5%. When you can get 5%. Step four, invest excess cash appropriately. Money you won't need for 1+ years. Short-term bonds. 3+ years. Diversified investment portfolio. 5+ years. Equities and alternative investments. Step five, automate and rebalance. Set up automatic transfers and rebalancing. Best financial plans run on autopilot. Specific example, you're 55 with $1 million in savings, still working, making $150,000 yearly, planning to retire at 65. Monthly expenses, $8,000. Emergency fund should be $24,000, $48,000. Here's how I'd structure that $1 million. $50,000 in high yield savings, 5% yield equals emergency fund, $150,000 in money market fund or short-term treasuries, 5% yield equals near-term liquidity. $300,000 in diversified bond portfolio, 6% yield equals conservative fixed income, $500,000 in diversified equity portfolio, 9% expected return equals growth assets. With this structure, you're earning $2,500 on emergency fund, $7,500 on near-term liquidity, $18,000 on bonds, $45,000 on equities. Total expected return, $73,000 per year or 3%. Compare that to entire $1 million in savings, earning 4%, $40,000 yearly. You're earning an extra $33,000 annually just by being strategic over 10 years, assuming reinvested returns. That's over $400,000 difference in wealth. That's the difference between comfortable retirement and wealthy retirement. I know this is uncomfortable. The safe approach you've taken might actually be destroying your wealth. But this is the reality of banking and finance in 2026. The rules have changed. If you don't adapt, you're getting left behind. I've been doing this over 4 decades. I've managed through multiple crises. I've seen fortunes made and lost. One thing I know, the biggest risk is often not taking any risk at all. When real interest rates are negative, cash is not a safe asset. It's a depreciating asset. You wouldn't keep $1 million in a new car knowing it'll lose 20% value in 2 years. So why keep a million in a bank account knowing it'll lose 10, 15% purchasing power? The answer is usually fear. Fear of volatility, fear of mistakes, fear of loss. But you know what's more frightening? Reaching retirement and realizing you don't have enough because you were too conservative too long. I see this constantly. People who did everything right, saved consistently, avoided debt, kept money safe. Then they reach 65 and realize their savings don't go as far because inflation ate away purchasing power for decades. Don't let that be you. Take control of your money, understand the real risks, make strategic decisions that protect and grow your wealth in the actual economic environment we're in. Not the environment you wish we were in, the environment we're actually in. That's how you build real financial security. If you found this valuable, I've got more to share. We're diving deep into specific investment strategies, protecting wealth during downturns, what the Federal Reserve is really doing behind the scenes, and moves billionaires are making right now. Subscribe and hit the notification bell. Drop a comment. How much of your wealth are you keeping in cash? Are you making any of these 5 deadly mistakes? I read every comment and respond to as many as I can. Let me know what you want to hear about next. Remember, your money should work for you, not the other way around. I'll see you in the next one.